Welcome to my channel. I'm the cover call guy, and my goal is to create $120,000 per year passive income using only cover call ETF. Right now, I yield about $72,000 a year, about $6,000 a month, and about $1,400 a week, and almost $200 per day. Today's video is going to be a great one. It seems like this topic does well, so I kind of brainstormed on how to kind of make it a better way of understanding the Mag 7. So before we get started, legal disclaimer. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. Now, with that out the way, today's video is going to be income through the Mag 7, right? My comprehensive analysis of single stock derivatives income ETFs. Same cake, different slices on the Mag 7 your way, and I'm going to explain that. All right, quick peeks, right? Financial engineering has completely changed the game. We are seeing a massive shift where you can now extract yield from high growth stocks that usually don't pay a dime, right? It's usually straight growth. And in this video, we are diving deep into the income through the Mag 7 landscape. We're going to be looking at the specific strategies by Rexshares, Roundhill, and Kurv. And I think it's all three. And maybe YieldMax too. I might forgot. I think YieldMax is in here. All right, key takeaway from this video. We're going to be talking about complex tools, which is just options, swaps, synthetic positions. The targets here is the Mag 7, right? NVIDIA, Tesla, etc., all the Google, Microsoft. The payouts is we're going to be looking at the massive yields from 12% all the way to 74%, and the reality, right? Where is this derivative distribution, not regular dividends, coming from, right? Is the yield fake or the yield real, right? We're going to be looking at the three, right? The critical bifurcation and strategy, Rexshares, Roundhill, Kurv, right? Rexshares uses partial cover. What that means, you utilize a 1.2x to 1.5x leverage while writing call options on only a portion of the portfolio to preserve upside. Roundhill manage distribution. I think Roundhill right now is the king of weeklies. They are doing very, very well. Yeah, they're able to hold the yield, pay out weekly without destroying their stocks or ETFs. So Roundhill right now it's kind of like that weekly king. They also utilize 1.2x leverage via swaps without selling call options. Upside directly uncapped, right? Of course, the bull market keeps going up. It's the leverage will keep always going up more than the actual percentage because it's leverage, but subject to NAV erosion if the stock stagnates, which we have seen. Right now the market is kind of choppy. It's kind of, when it comes to leverage, right? Leverage might not always do well in choppy or downturns. They will only perform well in a upturn market or raging bull market. And then we seem to have everybody's up and coming favorite, Kurv. The yield premium, utilize synthetic long positions and write out the money call options. Balance income with total return. Kurv seems to be the one that is most. They're trying to discipline themselves with the yield. They're trying to ensure that the yield is real. Understanding this category of ETF, we're going to be talking about active derivative strategies to accurately evaluate tickers like NVII, NVDW, and TSII. One must deconstruct the financial architecture, right? We got to know what's underneath the hood. These are active derivative strategies that substitute direct stock ownership with synthetic exposure to generate distributable cash flow. And then, of course, the evolution of synthetic yield, right? Historically, cover calls capped upside, causing underperformance in high growth markets. If you're not new, but if you are new, I say historically, cover call capped upside because I like to separate Generation 1, Generation 2, Generation 3 cover calls ETFs, right? For the most part, Gen 2, Gen 2.5 are like JEPI, JEPQ. And then we have the newer ones, Gen 3, with like NEOs, Kurv, Roundhill, the Goldmans. They don't allow that pure capped upside. They want to let the stock run for as much as they can but also collecting that premium. So you get the juicy premium and the NAV capital appreciation. So if you ever see Gen 1, Gen 2, Gen 3, and then there are some videos I talk about the future ETFs of Gen 4. I made a video about it. Go and watch it, and maybe it'll interest you and educate you, or you've already know about this. But Gen 1, Gen 2, Gen 3 is something I just made up. It's not an actual financial cover call term. I just made it up. These terms. The new generation of ETF, cover call ETF, attempts to solve this upside cap problem through 3 engineering solutions, right? 1, I believe, is leverage. 2 is partial covering, and 3 is out of the money. So they try to combine these 3. Engine type A, the partial cover accelerator. These are just nicknames I'm giving them. Rack shares, T-Rex, right? Tickers NVIW, NVII, TSII, and MSII. Mechanism behind this, it targets a 1.05x to 1.5x. These are leverage, right? Daily leverage exposure via swaps or synthetic options. The innovation behind this, they write call options on only a portion of the portfolio, right? For example, 50% of it. The implication, it creates a hybrid portfolio profile. The covered half generates income, while the uncovered leverage half allows participation in parabolic rallies. The yield source, option premiums plus T-bills and the interest. So here, people who want that daily leverage and partial cover would go for Rex, the T-Rex, right? Engine type B, the managed distribution long, goes to Roundhill Investment, the WeeklyPay, right? The tickers NVDW, TSLW, AMZW, METW, GOOW, MSFW, AAPW. I swear to God, when I rehearse this before putting this out, I reverse my slides going over. I reverse at least 20, 30, 40 minutes, and it's just much easier in my head when I'm saying in my head instead of saying it out loud. Oh my God. I gotta type these out better. I gotta figure out a way, but I like typing everything out. As you don't know, I work corporate. I do finance and legal, so I do a lot of presentation PowerPoints, and yeah. Anyways, mechanism targets fixed 1.2x, which is 120% daily exposure using total return swaps. Crucial distinction: does not sell call options. Not a traditional cover call fund, right? When they do swaps, is not a traditional cover call fund. So you got to understand that a traditional cover call fund most likely directly holds it and trades the actual underlying. Here, it does not. The yield source. Why do I use managed distribution? Because they say it like that. It's via their proprietary formula. They didn't get into it, obviously, because it's a secret. That's what it means. If you go and listen to their interviews and go and see what how they explain it, they don't really explain it. So yeah, it's the same with Neos. They don't really explain the formula. They just say, "Hey, it's a secret. This is how it works." Um, am I okay with that? Yes and no, right? I mean, yes, because yeah, if it's working right now, yeah, don't tell anybody, right? I want you to not have your competitor is not gonna want to know, right? If you're doing well, do it. And no, because in a way it does kind of scare me, because is it really a secret or they're just BSing, right? I'm always very critical because I do this for a living. Um, if you're very secretive, you got to have some type of anxiety, right? When you're putting a lot of money into this, I'm gonna eventually put almost $200,000 into Roundhill investments, so I got to think, all right, where is it coming from? I know it's a formula, I'm gonna try to crack it myself, but it's kind of like, I know it's a secret, but kind of give us a little bit more. But they don't. Niels does the same. They when you see it in these interviews, they get asked about it, but they don't talk about it. All right. So upside is completely uncapped. Oh, yield source funded by liquidating swap gains or principal, which is just return on capital. Implications: upside is completely uncapped at 1.2x. However, without option income buffering downside, it relies entirely on appreciation to sustain NAV, as you guys see, right? You guys have that chart. You just zoom out and be like, okay, it's doing well for the past year because the underlying itself has been shooting up. But when it comes to these leveraged swap positions, they take on the full downside. You guys will get absolutely wrecked during a downturn market, but you guys will moon during a bull run. That's just a trade-off here. It depends on how you really want that trade-off to be, and the yield. This is where the yield is coming from, right? So give and take. Engine type C, the yield premium. OTM writer, right? Kurv, investment management. The tickers TSLP, AMZP, GOOP, MSFW, AAPW, NFLP. Whew. Mechanism, right? The under the hood, synthetic long strategy or direct ownership for 1x exposure. So they do both. In perspective, I said they use synthetic in my other video. I was corrected. Thank you for correcting me. I understood the perspective wrong. They have direct ownership and they can switch their strategy to a synthetic long if the underlying becomes too expensive. So the pros with synthetic is it's a poor man's way of owning shares, right? They buy for pennies on the dollar. However, the counterparty risk is that they typically trade synthetic, not with the retail, not on the retail market. They typically trade it with other hedge fund banks or other, you know, big big boys. So we don't see it. Now, if those other parties cannot hold up their end and they've kind of like agreed to buy and they don't, your synthetic becomes worthless. So that's according to his leverage. So be careful of that. You have to understand that. The innovation behind this focuses on writing out the money, call options 5 to 15% above current prices. So that leaves you to appreciate your stock by 5 to 15%. The implication of this is that it captures the first 5 to 15% of a rally before the cap kicks in. Balance income with total return. Yield source, option premiums lower than at the money but safer, plus treasury collateral interest. So Kurv, they are very disciplined in this. It seems like they've want to give you the yield, but they want to make sure the yield is real, right? So that comes from actually making profits. I'm gonna say that again. Kurv is doing this because it is part of their strategy and their mindset. They want to give out the real. There's fake yield and real yield. Now, fake yield, obviously, there's a nickname for that fund, Erosion Max. I'm gonna get hated for that, but that's pretty much fake yield, right? The real yield is, or is the ETF, the stock, the fund making actual profits, right? So Kurv right now is disciplining themselves, and they're saying we want to make profits. Focus on the profits. Oh, that didn't load properly. Oh, yikes! It was loading for me. What happened? Okay, I'll just say it. It's pretty much a chart from right here. The yield landscape on comparative view. It sucks, but I don't know why it's not loading. It was loading when I opened it. Now it's not. Oh man. All right. Anyways, this chart basically is the great yield divide. So just try to visualize it. The chart visualize a stark contrast and analyze yield driven by volatility and strategy aggression. The aggressive zones is 50% plus. The leaders in this is TSII at 74% and NVII at 54%. These two are fueled by extreme implied volatility, IV, and Tesla and NVIDIA, sustainable only as long as volatility remains high. These are the aggressive. Moderate zone, 30 to 40%. This includes METW and GOOW. GOOW at 50% is an outliner for a stable stock. This is because it's suggesting aggressive return on capital, yield manufacturing. So be careful. Remember what I said: real yield and fake yield. And then we have the conservative zone, right? 12 to 20%. These are more of the anchors, right? AAPY, MSFW. These are lower, sustainable yields derived from out of the money calls to preserve NAV. Actual profits. You're getting paid actual profits. All right, the role of Volatility as an asset class, Forex and Kurv, yield is direct correlated to implied volatility, which is IV. High IV, such as NVIDIA and Tesla, options are expensive. Selling them generates massive premium. The result, this is how you get your annualized yields of 40 to 7%. Low IV, Apple, Microsoft, right? Options are cheaper, premiums are lower, sustainable yields drop to 12 to 25%. These are still great yields, by the way. Excellent yield. Anything above 8 to 10%, so traditionally anything above 8% is considered high yield. A lot of people think, oh my god, it's not double digits, it's not at least 20, 30, 40%. I don't want that. Traditional yields are anywhere from 1 to 8%, and even 8% is pushing it. Now I say 8 to 10% is the most sustainable because it follows the traditional markets. Anything above that, now you're kind of playing with like, okay, we need certain conditions to be met in the market. So 12 to 25%, these are excellent. If they were making profits off this is excellent yield. Just the FYI, a lot of people aiming for the 40, 50, 60, 80, 90. It's like, you guys are crazy. How can this be sustained long term? Right. All right. So critical insights into this: when a fund like Roundhill's GOW, which is Google, offers a 50% yield despite Google having relatively low volatility, it suggests the yield is being manufactured through aggressive return on capital rather than harvested from natural options premiums. This distinction is vital for long-term sustainability, which I was just talking about. I could have just read my own slide, but this critical insight is my opinion. This is kind of what I take from it. So it's not necessarily a fact. I just want to give my opinion on where this might be coming from. Um, Again, like I said, I kind of have anxiety when the yield is too high. I always want to say, where is the yield coming from, right? That's the first question you ask as a good investor. Where is the yield coming from? And I think it's being manufactured. That's why I put in quotes. It's kind of like you're putting money in, and it's just giving it right back out to you. That's where I think it's happening right here. NVIDIA, the AI volatility engine, right? NVII from Rex, the yield is 54%. The strategy, I mentioned in the earlier slide, 1.5x leverage plus partial call coverage. My analysis of this is that I capitalize on extreme premiums, uncovered leverage portions, outperform standard call and bull markets. Versus NVIDIA from Roundhill, NVDW, the yield is 43%, which is still amazing. Their strategy is a 1.2x, right? It's just a little bit lower. Leverage long, no options sold. My analysis is that yield is systematic liquidation of gains, mathematically superior in parabolic moves with zero cap, but suffers severe NAV erosion if NVIDIA trades flat. My verdict: NVDW for Super Bowls, NVII for volatility traders. So just depends on how you guys want to trade this and what your thesis is behind these two stocks. Tesla, of course, we got to talk about Tesla, right? The retail battleground, because Tesla is the retail's favorite, right? TSII from Rex, the yield is 74%. My analysis from this is staggering yields reflect immense premiums, double downs on beta, pure play on elevated volatility. Tesla from Roundhill, TSLW, the yield is 54%. My analysis is that it's highly variable yield, risk of prolonged drawdowns, plus a 1.2x leverage, decimating NAV. And then we have Tesla from Kurv, TSLP, the yield is 23%. My analysis is that lower yield is a feature, right? They're telling you, we're giving you this low yield because out the money call, preserve NAV and capture recovery moves. My verdict is TSII for yield maximizers and TSLP for long-term holders. Again, I put these on quotes because these are extremely high yields, and it just depends on how Tesla performs, right? The actual TSLA, Tesla performs. And long-term and yield maximizers is kind of put in quotes because it depends on Tesla. Amazon, the logistic behemoth, right? Amazon has a lower volatility than NVIDIA or Tesla, meaning organic yields should be lower. We have Amazon from Roundhill, AMZW. The yield is 30%. The strategy is 1.2x leverage long. My analysis is that recent data suggests about 20%. 1.2x leverage helps juice returns in a steady grinder like Amazon. And then we have Amazon from Kurv, AMZP. The yield is about 20%, right? The strategy is 1x synthetic plus out the money calls. Yield aligns perfectly with implied volatility, a sustainable hold candidate. So in this one, I say Kurv is doing very, very well because they were able to kind of sustain a little bit better in terms of their strategy and their yield. Of course, we can't forget about Meta, right? The reinvented giant. We have Meta from Roundhill. The yield is 37%. My analysis is that Meta has morphed into a higher volatility stock following its 2022 crash and the year of efficiency rally. A 30% yield is attractive, however, essentially monetizing the regulatory risk and metaverse spend, right? Zuckerberg is burning cash on that. And right now, the uncertainty that keeps Meta's premiums elevated. Google, the yield anomaly. Oh, God. Guys, you can read that, right? All right, so I name it that way because Google is often considered a safety trade. The divergence in yield is stark. My analysis from Roundhill is that the yield is about 50%. GOW. 50% yield is likely manufactured. Return of capital. That's what I mean by manufactured, right? It's kind of you're giving the money and they're giving it right back to you and be like, hey, we're paying you. Okay, thank you. Do it again. Pay me, reinvest it back. Google's premiums does not support this. As of right now, I don't think it does. I'm not seeing it. I don't think it's actual yield that they're giving out. So if you own it, if you're trying to own it, fact check me on this. Leave a comment and say, I might be wrong, I might be right. But I think right now that yield is too high for Google. I don't know how they're really kind of supporting this long term. In my opinion, it has a high risk of NAV erosion, right? Downward staircase price. It's just going to keep falling. And then we have Google from Kurv, GOP. The yield is 13%. My analysis, yield is honest here and reflects actual premiums. Far more sustainable for long-term holding. Even though, we see GOW shooting up to the moon and it's positive right now, we have to figure out where that 50% is coming from once that drawdowns happens. I'm not saying it can't. I'm just saying we got to be a little more suspect of that 50% yield from Roundhill. Whereas Kurv GOP is a little bit more, okay, I can understand that 13% where it's coming from. I think Kurv right now is a little bit more disciplined, and they're able to kind of hold themselves together, and they're saying the yield is real because we're making actual profits from the premiums, and we're not just giving you your own money back. It's my opinion. That's what I think. I could be wrong. Let me know if I'm wrong. Microsoft, the bond equivalent, right? And I say bond equivalent because Microsoft is basically as stable as a bond. The lowest volatility of the Mag 7. MSFW from Kurv, the yield is 28%. My analysis is that this one is surprisingly high from Kurv. I didn't expect that, right? Because so far they've been pretty sustainable in terms of the yield and not really being that high. So this one is an anomaly for Kurv. I think this one is a little suspect from Kurv. I wonder where they're getting this 28% from. Right? It may suggest aggressive writing or specific high volatility event window. Right? Verify this is a one-time. Verify if this is a one-time spike. I need you guys to verify this and tell me if I'm wrong or not on this. correct me if I'm wrong, because this one I was a little bit kind of confused. I was like, where is this 20% coming from? I might not have found the information. Maybe if you guys own this, let me know. And then we have Microsoft from Roundhill, MSFW, about 16%. My analysis is that yield with a 1.2x leverage profile on a low volatility stock. I can't have any take on it right now. I have to see if if it's gonna hold. This leverage is gonna hold when it comes to a downturn, because when there's a downturn, it takes on the full weight of exposure. And I think this one is down like 20% all time. So leverage right now is kicking its ass, and that's just the down. That's just the drawdown of leverage, right? I mean, you're not gonna you're not going to expect leverage to not do its thing during a downturn. This is going to happen. And we have Apple, which is the fortress. Apple really is like the fortress. It's been given that nickname by God. Who's that bald guy that always gets things wrong? Yeah, I'll probably remember the name later, but he named it. Um, I think his name is Jim Cramer. Anyways, I think he nicknamed the fortress, and I completely agree with them. It is low beta, high buybacks. We have Apple from Roundhill, AAPW. The yield is 30%. My analysis is that 30% yield is mathematically difficult to sustain from pure alpha. Likely return relies on leverage and return of capital. And then we have Apple from Kurv, AAPY. The yield is 12%. My analysis is that Apple, right, with less than 1% dividend into a double digit yielder, conservative income enhancement strategy. So this one is tough too for 12%, just because Apple itself doesn't really move much, or it's not volatile at all. So, yeah, this one is a difficult one, but 12% is much more sustainable than that 30%. Then we have the basket, Mag 7 Maggie, right? How can we forget about Maggie? This one is from Roundhill, MAGY. The yield, they are trying to aim for 34%. The structure, funds of funds, hold Roundhill Max ETF and write calls option on it. The benefit, right? It doesn't hold a single stock like all the other ETFs on stocks we mentioned, right? From these funds. So it doesn't hold any of the idiosyncratic risk reduction, which just means idiosyncratic just means single or one. Impact of single stock events is diluted. The trade-off correlation risk and micro sell-off and macro sell-offs, all seven move in unison, which is what we're seeing right now, right? The market is kind of having a little sell-off. The market is coming down, so Maggie will reflect that, right? So I mean, for me, it's like whatever. I just buy the Mag 7 at a cheaper price then. Suitability, excellent for tax exposure plus income without managing individual K1s that you would have to manage if you bought the single stocks. Who are these best for? Part 1. If you are the cash flow trader, best fit REC shares, NVII, TSII. Why? Bullish but want cash flow. You're comfortable with leverage 1.5x and partial cover to participate in rallies. The risk, significant drawdown risk during market corrections. If you are the aggressive growth optimist, best fit Roundhill, right? NVDW, TSLW. Why? You believe borrowing isn't over. You want the 1.2x leverage stock position that forces profit taking, zero upside cap. The risk is the NAV erosion. Right, betting on price appreciation to fund the yield will most likely use a double-edged sword. So when it goes up one way, it can also go down the other. Part 2, the total return compounder. Best fit, Kurv, TSLP, AMZP, GOOP. Why? You want growth exposure with a smoother ride, willing to sacrifice headline yields for sustainable 15. It should be 12. It should be 12 to 25% yield and room for growth, right? Out the money calls. Who should avoid these? If you're a pure income dependent, right? Income is variable. A 50% drop in stock equal a 50% drop in paycheck. If you're the passive investors, I don't even know what you're doing here on this channel, because we are cover call ETF and the income channel. If you're a true passive investor, I have no, you don't even want to be investing for income, then it's not for you. It requires active monitoring of splits, strategy shifts, and taxes. Oh, and this one didn't load too. What the heck? Huh. All right, risk versus reward matrix. Where do you fit? Right, navigating the matrix. This scattered plat maps the trade-off between yield and structural risk decay. Now, if actually the picture did load, I don't know what's wrong. This was there's plots here. If you know, I'll just read it. All right, the top right, high octane. It just means that the highest risk tickers TSII and NVII, right, high yield plus high risk, purely for volatility harvesting in bullish choppy markets. And then the bottom left right here, right? Well, actually right here, the bottom left. Premium zone tickers AAPY, SFW, lower yield plus capital preservation, best suited for longer term income strategies. Then we have the warning. I think the warning was somewhere here. I don't know, in the middle or going up. The yield trap, right? High yield on low volatility stock, GOW, 50% is a red flag for NAV erosion. So beware of that. It may not have NAV erosion now, but just beware of that. I'm not saying it has it. I'm saying just beware of it. Of course, taxes, right? Taxation. We also got to talk about taxes. Roundhill weekly pay distribution, often characterized as return of capital, deferred taxes until sold, lowers cost basis. Rex and Kurv, income is generally ordinary income or short-term capital gains, does not qualify for favorable 60/40 tax treatment, section 1256, and the liquidity impending. As these funds grow, massive option premiums can impact the underlying stock. What that just means is market makers hedging these positions can dampen volatility and pin the stock price near strike prices, potentially reducing the very volatility these stocks need to thrive. My verdict: if you're into muscle cars, Rex Shears is for you, right? Loud, fast, and capable of massive performance in the right direction. Foot on the gas and no brakes, right? That's the Rex Shears for you for maximum income. If you're the leverage compounders, Roundhill, NVDW, TSLW, automated profit taking without capping upside for uncapped growth. And then if you're into the more luxury sedan, you know, you're more of the, hey, look, I like to flex, but I'm okay with buying a Lexus or a Acura or a Mercedes, a nicer BMW, but I'm not into the crazy luxury. Kurv, TSLP, GOP, smoother ride, preserving capital with respectable organic yields for balanced total return, right? You are the millionaire that doesn't need to own $1 million type car. Thanks for watching. If you found value in this deep dive, join the community for more insights. Subscribe, comment, like. If you like something like this, give me another idea of what you think I should be putting together. I found out that Mag 7 did and Tech Stock did well with this channel, and so I thought, you know what, a lot of ETFs did Mag 7. I'll just put a lot of things together and see how it performs. I guess I didn't have YieldMax in here. I guess not. I said in the beginning, I guess not. Maybe I should have put YieldMax in here. Huh, I thought I did. Anyways, thanks for watching, guys. Stay tuned. Catch you guys on the next.